Hi there, welcome to kneppyinvests. If you watch quite a few of my videos, you notice I'll focus on receipts growth in my Appendix 4C or 5B videos, and also revenue growth in my financial year 22 videos, which I've been doing for about the last month. So the question you might be asking is, why am I focusing on revenue growth? And why is revenue growth so important, particularly for long-term investing? And finally, I have found some research on why and how revenue growth is so important for long-term investors. And this really makes me even understand why I have tended to focus on revenue growth, cash receipts growth over the past, say, 7 to 8 years, and why it's really the first thing I look for when I am researching a company. I found this little bit of research actually going through a newsletter, the fund manager newsletter, Hayden Capital. In fact, this newsletter was released on August 12th, 2020, and they provided a really interesting graph here via Morgan Stanley Research and BCG Analysis. BCG is Boston Consulting Group. And the title of this little bit of information in Hayden Capital newsletter was titled "Sales and Earnings Growth Drive Returns Over the Long Term." And the little bit of information from the Morgan Stanley and BCG research is titled "Top Line Growth, the Long Run Driver of Stock Performance." Top line growth is revenue growth or sales growth. So what they're saying here is sales growth or revenue growth is the most important factor for the long-term success or share price performance of a company. So sales growth is the key driver of long-term stock performance, and this is a source of total shareholder return for the top quartile performers. So the 25 best performers in the S&P during the period 1990 to 2009. They also broke it up into different periods: 1 year, 3 years, 5 years, and 10 years. And when you're looking at the longer term period, revenue growth becomes more and more important. In the shorter term, it's mostly around multiple or valuation. So, for instance, in the first year, 29% of stock performance can be attributed to revenue growth, 13% for margin, 46% through valuation or multiples, and 12% because of free cash flow. As we move into a 3 year period, revenue growth becomes more important. 50% of a share price performance of a company is attributable to revenue growth, 20% in margins, 19% in multiple, and 11% in free cash flow. But once we transition to a 10-year period, 74% of the share price performance of a company is because of revenue growth. Again, 74% is because of revenue growth, 15% margins, 5% multiple, which is just valuation, and 6% free cash flow. And this is probably one of the reasons why a lot of tech companies and the management of tech companies, CEO of tech companies, tend to focus just on revenue growth and not really focus on anything else. And that's one of the reasons why a lot of tech companies' share price and valuation just flew significantly higher over the past 10 years, excluding the past year. So this is one of the reasons why I really focus on revenue growth and cash receipts growth for those companies that do release their quarterly results. And it actually is really easy to understand why revenue growth is so important to drive the valuation of a company higher and hence the share price higher. And the way I look at this is the best way for the profits or the cash flow of a company to increase and consistently increase through time is for revenue to consistently increase through time. For example, if you had a company, we'll say actually two companies, and company number one, they increase their profit by 10% from 1 year to the next year. And the second company, company B, also did that. They increase their profit by 10% from 1 year to the next year. Now, say company A increased their profit by 10% because they just cut their costs by 10%, or maybe they increased their margins to increase their profit, but revenue went sideways. There was no increase in revenue. Now, compare that to, say, company B, who increased their profit by 10%, increased their revenue by 10%, margins remain steady, and maybe even costs increase by 10%. Which one has the greater potential to keep on improving their profit over the longer term? It's company B. The reason it's company B is company A increase their profits by decreasing their costs or increasing the margins. And increasing margins and decreasing costs are finite ways to increase profit. You can't increase your margin to more than 100%. So it can only get to 100%. And you can't decrease cost to below $0. There's a finite amount of movement. You can drive margins higher or costs lower. But when it comes to revenue, can increase your revenues by an infinite amount. You can increase your revenue from $10 million to $100 million, billion dollars to $1 trillion. It's infinite, the amount of revenue you can increase. And that's why the best sign of the future success of a company is if they can increase their revenue through time. And that is one of the reasons why I focus on receipts growth in Appendix 4Cs and 5Bs and on revenue growth when I'm looking at financial year reports and the history of these financials for these different companies. Now, in saying that, I just not just focus, but I do focus on revenue growth and receipts growth. It's not the end of the story. And thankfully, there was another article from BCG that shows you just focusing on revenue growth is not the end all of researching companies. So let's have a look at some of the things that were mentioned in this article from BCG. This article from BCG was 10 lessons from 20 years of value creation insights, released on November 27, 2018, written by quite a few people: Hansel, Kotzen, Olson, Ruse, Wick, Newman, and Farag. And I'm not going to go through every single lesson. I'm going to focus on one lesson that pertains to revenue growth. And even though revenue growth is the most common path to total shareholder return outperformance, it's not the only path. And not only that, revenue growth is the most common path to share price outperformance. It's also one of the most common paths to value destruction. And this is the first point that BCG are trying to make. It overlooks that myopic pursuit of growth is one of the most common paths to value destruction. And they raise a couple of points here. The first point is in regards to mergers and acquisition moves gone bad. And we actually see this quite a bit on not only the ASX, but on all equity exchanges. And research has shown that the majority of acquisitions do go bad, and instead of being value creating for shareholders, is actually value destroying for shareholders. And this is particularly true for larger companies. So I'm very wary of any large company that goes through acquisition binges. Even smaller cap companies, and there's less clear research on this. In fact, some of the research I have read shows that acquisitions can be beneficial for smaller cap companies, but I'd like to see further research on that. So I'm very wary when it comes to acquisitions. And one of the ways I get around this potential problem is instead of looking at revenue growth, I focus on revenue per share growth. And one of the reasons why a lot of companies and managers of companies, CEOs of companies go on acquisition binges is because acquisitions are one of the best ways you can increase your revenue fairly quickly. You can go from $100 million of revenue one year to $200, $300 million the next year just because of revenue. But to fund those acquisitions, most companies will do capital raisings, increasing their shares on issue. So I will focus on, instead of just revenue growth, focus on revenue per share growth to get around this potential problem. The next point they do make here is prioritizing growth at the expense of margins. And this is a really important point. So when I look at the financials of a company through time, I want to see revenue growing or revenue per share growing, but I also don't want to see margins dropping through time. This is a major red flag for me. And I have the perfect example of a company that focused on revenue growth without caring about the margin. And that company was Alexium, ticker code AJX. So about 5-7 years ago, the revenue for this company, Alexium, was increasing at a really impressive rate over about a 2-year period. And the reason revenue was growing at a really impressive rate was because the CEO at the time was solely focused on revenue growth. And to get that revenue growing, he was bringing in lots of low quality revenue. And when I say low quality revenue, I mean the margins were really low. So the margins were falling for this company, even though revenue was growing at a fairly quick rate. And this company was finding it really hard to become profitable because of that really low margins, of that really low quality. Then the CEO left. A new group of managers came in, and that company is now focused on high quality revenue. So even though revenue has dropped a lot, the margins are going up because of that high quality revenue. And I think they have a better chance of being successful in the long run because of this change in strategy. The other two little points they make here, I won't focus on at all. Betting on a cycle that collapses, or investing in adjacencies in which the competitive advantages of the core business do not apply. Now, the second point that BCG made is that there are many examples of top quartile value creators generating total shareholder returns from some combination of other factors, not including revenue growth. And they mentioned a few here, and I'll focus on three. Actually, I'll focus on two. The first one is margin improvement. Now, I've already mentioned earlier in this video that a company can have zero revenue growth and still see the share price increase through time if margins are improving through time. Because if margins are improving through time, even though revenue is not growing, that means profits are improving through time. But as I also mentioned, there's only so much a company can increase their margins. And there's a possibility that margins could be cyclical. So they could be improving through time and then start dropping. So preferably, I would like to see revenue growth through time. And actually, a combination of the two would be ideal. Revenue growing through time at the same time that we see margins growing through time. And that actually would be a sign that the company is creating a good moat, a good competitive advantage. The second point I'd like to mention here is multiple expansion. A company can see their revenue go sideways through a 10-year period, but if the P ratio of that company increases from 20 to 40, and there's no margin improvement, no margin or lack of margin growth, then the share price of that company will double just because of multiple expansion. So that's another way that a company can increase the share price without revenue growth, is just through increasing sentiment of that company, an increasing premium that the market is willing to buy for that company. But again, there's only a finite limit. There is a finite limit to multiple expansion. You won't see a company go from P ratio of 20 to 40, 60, 80, 100 without any sort of revenue growth. So I think there is a limit to multiple expansion. There is a limit to margin improvement. And that's the reason why I prefer to find companies that can increase their revenue over time, and preferably not see their margins drop as well. So that's why I focus on revenue growth, is because I think it is the most reliable way for long-term total shareholder returns. That's all I have for this video, looking at the importance of revenue growth for long-term investing. And I hope this clears up any confusion or clears up any questions you might have on why I tend to focus on cash receipts growth for those companies who release quarterly reports like Appendix 4Cs or Appendix 5Bs, or why I seem to be focusing on revenue growth for all these financial year 22 videos I've been doing over the past month. If you have any questions, or you want further insight, or you need something cleared up, if you question my strategies on not just looking at, but looking at revenue growth and focusing on revenue growth, I'd love to hear your opinion. So leave it in the comment section of this video. If you have any questions, leave in the comment section of this video as well. So that's all I have for this video. Have a good day. And just remember, I'm not a financial advisor. So if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.